Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Higren. Hey, Doug.
Happy Friday, Kirk.
Happy Friday to you. And it is May 1st. Happy May.
It is. You know what that means? Guess what's coming up next week?
May the 4th be with you.
That's right. And guess what's happening today? Or
Not Cinco de Mayo.
no, I'm sorry. In the same week. In the week. Yes. I guess that's not
Cinco
how
de
it works.
Mayo and May the 4th be with you.
Yeah, it's a
Yes,
great.
that is, yes, that is a wonderful, wonderful week it is
We
for
get to
Star Wars
start
fans.
last month with everybody coming up with ways to prank each other. This month, we actually get to celebrate in fun without looking over our shoulder. So, and spring, and it also means spring is on the way, which, finally, for some of us up north that have to wait a little longer than others.
It does feel like spring's here. I'm starting to get some flowers coming out, and allergies are starting to subside because that's been pretty much all of April. So yeah, excited for May. It's been a crazy month. It's been a crazy year. Every month's been kind of nutty this year, but I we've been talking a lot the last few weeks about patience and caution, and I think one of the challenges that we're having this year is it's in a normal year, the markets are pretty much following a certain trend. And then once in a while, you get a hiccup or a speed bump. Like last year was March. We had the tariff tantrum and everyone freaked out. And then the markets went up and then everything was fine. And, um, we had this kind of market movement last year. But other than that, the markets pretty much just went up. And this year is a little different because there's a new war, as if Ukraine wasn't enough. We got a new war or a military conflict or whatever they're calling it. But we got a new war going on, which has kind of thrown a lot of people off. Um, because the markets were at all-time highs before the war, and they didn't go down that much with the war, even though nothing has really changed. The markets are now at all-time highs again. Go figure. What do we make of this? Well, let's try to break this apart a little bit so we can kind of talk through how people should be thinking about this. We talked about it last week with the different paradigms, right? We had pre-war paradigm, we had war paradigm, and then we have post-war paradigm. I'm going to call it post-war because Trump said the war is over, even though it's not. But the market took that and said, okay, it's over, and just leave it at that. So, we'll call it post-war paradigm. So what's been interesting is pre-war paradigm was very clear what was going on, and the trends were clear. You could make lots of money. It was great. That was January and February. Um, February, it was almost to the button. Like last day, okay, March 1st, all right, it's a war. So March was rough, with the war, and the markets went down close to 10%. And then towards the end, I think the last few days, the market started to rise, and then April, it's gone up. What's been interesting is the paradigms have been refined to the months. So January is a great month for precious metals, and then the last day it wasn't, and then February is a great month for everything else, not precious metals, and the war. So each of these kind of different paradigms have taken on a life of their own. Now, what's been most interesting to me is the fact that they're so clearly defined. Um, we've had since the war, quote unquote, is over, the new paradigm is interesting because it's not taking on a normal form. It's taking on a very traditional coming out of the doldrums, hit the bottom of the market and starting to rise kind of form, which is just focus on tech. It's not a rational approach, but that is more or less what's happened. We've had a very interesting dissection of different sectors. Some sectors you would think that are doing well or not. Semis are doing well, but if you look around the horn, it's really all over the map. This week was the big earnings week of earnings season. We had most of the big tech, virtually all of the big tech, not all of them. We didn't have NVIDIA, but we had all the rest. I'm just trying to pull it up so I can share it here. Here we go. So pretty much this is the first 3 weeks of earnings season. First week is mostly financials. Second week was a hodgepodge of different things. Third week was also hodgepodge, but you had all the big tech too. So you had, you had things like Coca-Cola, you had financials like Visa. You had Wednesday, Microsoft, Alphabet, Meta. I thought there were more that day. Well, anyway, then you had Apple, Amazon, and today you've got ExxonMobil, Chevron, Linde. So if you kind of look at this, there's huge names this week, and there's a bunch that weren't on this list that also showed up. So this isn't everything. What we should take away from this is a big week. We also had, Fed announcements. We had a whole bunch of economic data coming out this week. It was a big week. And it was a good week in the market. The market seemed to like all the data coming out. Now, we'll tell you that despite all the data coming out, it doesn't mean that it was a great week for all companies. If you look at yesterday or Wednesday and yesterday, some companies did really well and some companies not so much. We had, Alphabet did well, Meta did not. I think we had, I didn't have to pull up these when Doug's talking, but we've had kind of this hodgepodge. So overall, it's been good. I think the economy is still strong. We're definitely seeing some signs for a recession, but given that it's way too early and frankly too weak at this point, I'm not too concerned. The things to take away from this, though, are we do have a 10-year rates closing on 4.4%, which is kind of the line in the sand that Trump has seen in the past. 4.5, 4.4 is the line in the sand where they're just like, all right, we're going to do whatever we can to bring that down. So they are defending that line. It looks like Europe is going to start raising interest rates, and we're not, which does give us some latitude to raise them. But I know Besson is clearly concerned about that 4.4, 4.5 level. We'll see if it holds up. But as long as we're blockading the Strait of Hormuz, I'm not quite sure that certain markets are going to do very well. Europe, emerging markets were rough weeks ago, and they're just getting worse. Europe is raising rates. They were concerned about inflation. They've got like $12 a gallon gas, like crazy prices. Although theirs is always typically high, but definitely higher. So if you're a fundamental analyst and you're looking at this market from a rational perspective, you're saying, well, rationally, these are the things that should be happening. Oil prices should cause inflation. It should cause stagflation as well, meaning a stagnant economy with high inflation. It should cause commodity prices to go up. It should cause transportation stocks and staples to not do well. Many of those things are happening. But I think what most of us miss is just because oil should impact and should cause stagflation in the economy, it doesn't mean it's going to happen right away, and it doesn't mean it's going to happen at all. I suspect it might, but given the fact that the government's very aware of this and they're trying to do everything they can to stop that from happening, I would say the chances of that happening are relatively low. Or if it does come, it will be masked with, we'll call it bullshit. A lot of government data is not altogether accurate, and I suspect we may see the same here. So the things to worry about are, I would be very concerned about emerging markets. Unfortunately, the emerging market ETF is mainly made up of China, which I'm less worried about China. But if you can kind of remove China from it, I would be concerned about the rest of the emerging markets. I think there's concern there because of the oil prices, and they're so reliant upon that will really impact their economy. I would be a little bit cautious about things like interest rates going up. So interest rate sensitive stocks that lose money when interest rates go up. I'd be, tech, non-transportation. Like if you look at tech stocks, they've been going through the roof, especially semis. Is it warranted? I don't know, but I do know that money is flooding into the areas that traditionally it's flood into when you come off a bounce, which is tech, mainly tech and semis has really done the best. So there are other companies that have done well, but as a sector, that has been clearly the winner. Energy's still going strong. I'd be a little concerned about energy because as soon as this war is over, I think energy prices are going to take a hard nosedive, but that could be any day or it could be 5 months from now. We have no idea. So if you're trying to handicap this market, good luck. Roll a dice, flip a coin. Your odds are what they are. You're not making an educated decision right now, for the most part. There are people who are claiming that interest rates are going to go a lot higher, and they're betting on it. Smart people, like Stan Druckenmiller, for the last few months has actually said interest rates are going higher. He's been mainly right. He wasn't right when he made the call, but he's been right when the war started, and he could be very wrong at this point. We could be at the turn, or I suspect that over the next 6 months that rates will probably be lower, but a lot has to happen for that to happen. And the more this war drags on, the less likely that outcome is to happen. So I think interest rates are going to be lower at some point. I do think that if we continue this, if we continue blocking the Strait of Hormuz, then interest rates are going to keep going higher. Inflation is going to keep going higher. And then when that war stops, I do think that oil prices, interest rates are going to drop like stones. Maybe not right away, but more or less, you're going to start to see them rapidly drop. That's the kind of thing that it makes it hard to invest, is you clearly have opposite ends of the spectrum. You're blocking the Strait of Hormuz, interest rates a lot higher, oil prices higher. If they unblock it, interest rates down, oil prices down. How do you invest? Sometimes the best thing to do is nothing. You just get out of that ring. Unless you have some wisdom or knowledge that is better than most people, I would just stay clear. I don't think you have anything to lose other than FOMO for just sitting on the sidelines and waiting it out, or finding individual companies that have strong fundamentals, that are in strong sectors, that should hold up regardless of what's going on. But I do think there's a lot of landmines out there, and you have to be careful.
This is a public service announcement. Have you ever played the lottery? My state advertises that you can't win if you don't play. What they don't tell you is that the lottery is a tax on people who are bad at math. How many lottery winners have you met? Probably none. If you don't like your chances of winning the state lottery, you're definitely not going to like the chances of winning the inflationary lottery. The inflationary lottery? That's right. Your chances to win the state lottery might be 1 million to 1. But you're guaranteed to win the inflation lottery because it affects everyone. And the prizes stink. But here's what you're going to win. Higher prices at the store, shrinkflation in your packaged goods. Higher heating prices to heat your home. Who doesn't want to win that lottery? Much like the government, I feel bad that your costs are rising. So I want to help you out by giving you some free money. It's not a lot. It's only 1 million Zim dollars, but it's something. Well, you can't buy anything with it, but it does look good as wallpaper. And if you live in Europe, you might even be able to use it to heat your home this winter. If the lottery is a tax on people who are bad at math, then inflation is a tax on people who are bad at economics. I want my listeners to be better at economics. So I'm giving my loyal listeners free money. Go to www.moneytreepodcast.com/free money. Follow the instructions to get your free money today. I have a large audience and a limited number of these currencies. So let's make sure we get yours before we run out. Go to www.moneytreepodcast.com/free money. Follow the instructions and get your free money today.
What are your thoughts so far, Doug?
Well, I think the issue, the data this week gave us something we didn't have before, and it's a little bit of I'd call it confirmation. When I look at kind of what's coming into it, the data was mixed. Before we had soft signals, and the GDP is kind of confirming that. So a slowdown is no longer theory; it's starting to get built into the data. The Fed is stuck again with inflation being sticky and wages are still elevated. We got some charts I can come back to on that. Growth is slowing. And so this is ultimately, when we look at, like you just mentioned, this is the Fed's least favorite combination. We saw a 30% spike in gas prices just over the last week. So now, you're starting to see in the more favorable gas price economies, which tends to be kind of the middle of the country, we're now seeing those averages over $4 a gallon. And, we started this a couple months ago with a pretty consistent $2.50 a gallon. So when you start looking at $1.50 growth in, cost on fuel, which, permeates everything, right? And of course, you feel it as a consumer who was already getting pinched. We saw the layoffs, that have occurred over the last several months. So we start adding those headwinds in, it's going to start affecting the consumers at an increasing level of economic status. And so that, you're going to looking at, even at the bottom tier, which still feeds a lot of the economy, you're still seeing, you're seeing the effects that, that we've talked about the last couple of years of raising interest rates on mortgages, and how the cost of acquiring, real estate. Then of course that goes against valuations that have maintained a very sticky high level because things are not moving. So with no inventory, the demand is not, the price doesn't come down because the demand is even though that got hit off of the cost, you still have this limited supply. And so then you add in college, tuition loans that started to hit again. And now you start squeezing people $1.50 extra a gallon. That does start to have these kind of delayed effects we were talking about last week that expect to start really showing up here potentially in the, over the next quarter. We're in May. The old saying, sell in May and go away, right? And again, this is not something you live by, because every year we've had a number of years where that hasn't held true. If we're going into the summer with elevated gas prices and those don't reset, then that's definitely something that is going to be an ominous economic data and an ominous effect on consumers, and again, leading into profits and revenues for the markets. Additionally, you add into the fact that this is now the time in which we start to see a spike in housing momentum. If we don't see that as well, and that has a lot to do with where the consumer might be able to tap into equity, maybe we start to see more, opportunities for, this freedom of liquidity, whatever reason that might be, downsizing, etc. If we don't start seeing that happen, again, that is not necessarily a positive going into the summer. But as of right now, markets are ignoring the slowdown. Equities continue to be holding. We've had this nice spike. Risk appetite mainly still there. And it's holding up better than the data is. But this is also, I would say there's a reason to be very, very, very careful. And this is what I would call a margin squeeze economy. We've got wages elevated, growth slowing, cost sticky. And that means that companies are going to be positioned to start getting squeezed by both sides. And so when I say margin squeeze, I'm not talking about margin calls. I'm talking about margin squeeze on the bottom line of companies. And so if they're continuing, and they're trying to cut costs, that's why we've seen layoffs go up. But if, we're seeing costs overall coming in, which of course, oil prices very high in that, especially in industrials, starting to creep in and what it costs them, they're going to try to pass that to the consumer, but the consumer can only take so much. And that means that, consumers potentially continue to slow down their spending. So now you start to see a revenue drop, even, based on the cost being higher. You start to see that means that what is Wall Street like? They like growth, and they like continuing to see these numbers get hit. So when those start to get more difficult for companies to report, again, not now, talked about this last week, this is a lag effect. And then you start to see the wages continuing to be costly to get the talent they want. That's when you start to see all of the wonderful ingredients of missing on projections, missing on numbers, and that is definitely something that can create a shock into the economy. And these companies are going to have to do one of two things. We talked about it last week. They're either going to have to, one of a couple things. One of them is they're either going to have to start lowering expectations, which Wall Street doesn't like. That creates a dip that then they can come out later and beat. Okay, but you still got to weather that storm. Or they're going to come out with surprises, which Wall Street can't stand because now they were expecting something and you get bit, just like we saw with Meta and a couple of these other companies. Or they're going to start shifting revenue internally and do some funny accounting. Sometimes, most of the time, that's legal. We've seen situations where it hasn't been at times because what they're trying to do is then shift things to make the numbers look better, but not necessarily organically from what's coming in the economy. This is where they start getting creative, maybe shifting expenses or, doing write-offs strategically. So again, that can only go so long. And if the economy, if they can get through a cycle and make it look good, and then the economy can, reset itself, maybe the war's, over, all of a sudden, they're able to see a spike in real organic, financial health again. Maybe they can bridge that gap. But if this continues, as we've talked about, and it leads into the midterms, then you start getting political shock. You continue to start seeing financial shock, and that is not necessarily a great combination for elevated, all-time highs. Those can come either seeping back to earth or crashing back to earth when we start to see data that doesn't reflect that positive outlook that everybody wants to continue to see. We did see some shifts this week in the in the political side of things. We finally got a government that has passed on to Trump. We'll see what happens. A spending bill. They did strip out a lot of the controversial stuff. They're going to fund that elsewhere. So I don't know. Good for them. So that could help. That's going to be interesting to see because of obviously a lot of government workers weren't getting paid during that time frame, and it was affecting a lot of talk about Homeland Security and TSA. So that's going to help stabilize something that's been just kind of looming out there, but really as kind of a big nothing burger. I mean, we haven't reacted to the fact that the government's been locked up on this hardly at all. So I don't really see a huge shift in everybody clapping that it got resolved either. But if it does get signed off, that does tend to help with the flow of money supply through the government spending and employees. So that it's not a negative thing, at least on the short term. Housing still not, as I said, it's still not confirming anything. Weak demand, low transaction volume. It still continues to vote no in this economy. And consumers are still spending, but we're still seeing debt go up and rise. So where they're spending from, depending on their level, is again kicking the can down the road. That seems to be the economy we live in, Kirk. Everything just gets kicked down the road to be a problem, or something that's going to be resolved later, maybe. We're in a grinding market. No collapse, no breakout. But there's definitely disconnect there between the markets and the economy. And the next risk that I see, if I'm going to summarize all this up, it isn't an inflation spike. I don't think we're going to have that. I think if we have inflation, it's just going to be a maintainer, maybe a steady increase as we kind of recently saw, or maybe it tempers back down. And I don't think it's going to be the war. I mean, we've already been in it for months, and we're starting to get into the point where there is going to be some feel from that. To me, the biggest risk that comes, and this is the one that stock market cares about the most, earnings compression. What has been the thing that's been driving this market to all-time highs over the last several years? It's no matter what happens, they just continue to blow out their earnings. Well, if they stop doing that, that's when the markets are finally going to say we've had enough if we look historically. And so the next move, as I said, it's decided by the margins.
Yeah, we live in an interesting time with interesting markets where you can't trust anything. you can't trust the data from the government. You can't trust the data from the companies. The companies are manipulating the perception, and I'm not saying that the numbers. I want to be very clear. I'm not saying they're manipulating the numbers, although many companies do massage them and have for a while. But they do, as Doug was saying, like they do manipulate the earnings targets, so they keep the bar low, so they are easily able to achieve it, and then it sounds great. But let me share this. This is this week. So we had the biggest earnings week, the biggest companies, the most important companies this week in any earnings season. They all kind of virtually all report now. Then if you look here, like what's done well and what didn't this week, it's been kind of a hodgepodge, right? So you got Microsoft is down a little bit for the week. Nvidia is down, even though they didn't report. They're I think a few weeks from now. But Apple reported that was good. I think they were reporting some growth. You had Tim Cook announced his retirement last week, which in itself is actually pretty interesting. If I was listening to some people talk about it, if you think about Steve Jobs, who's this just culture figure with innovation, and then you got Tim Cook, who has zero innovation but is a great manager, which was his role, right? Is to manage this big business for what was already there, and not try to have big misses. And there were a few times he did try things like I think called it Titan or Atlas, where they try to do the Apple Car. They tried to get into a few areas, and none of them seemed to work. So they just, I don't know this new guy yet, but I do think that Apple's in kind of a position where they're going to have to start innovating, or at some point their lunch is going to get eaten, right? It's kind of like IBM. IBM was the biggest, the best decades ago, and now it's just another company. And maybe that's what Apple turns into, but who knows? At this point, it's still early. But it looks like Apple's up for the week. They had earnings. Amazon slightly up, Tesla up, Google's up a decent amount. Meta's down. Eli Lilly reported yesterday they're up. Have the Visa. Then you got some big losers for the week. You had Stryker came out, I think, yesterday. His numbers weren't great. I think it was at close. So this is probably this morning. Genova, which actually had good earnings, and so this is probably just energy coming off of it. Caterpillar, good numbers. Philip Morris or Altria, good numbers. So you kind of look through this. There's definitely some hits or misses. Overall, it was a good week, but interesting
semiconductor equipment that's down, even though the semis did extremely well in prior weeks. I think it was last week the semis came out. So, we're getting a lot of the earnings out, which is interesting, and we're starting to see this. I think the big question, because I know we had energy today, and I haven't had a chance to look through it, but if you kind of look through these areas, it's a good, every once in a while, it's good to see this kind of money flow map, because you get a feel for like what's performing, what isn't, what sectors are doing well, which are not, and maybe focus more on the sectors that are doing well. Look at energy, obviously they're doing well because of the war. Look at the areas that are not doing well, like medical devices. And frankly, one of the worst performing sectors so far this year has been healthcare. And I think the earnings this week from Eli Lilly and a few of these are making it look better now. But if you look at the charts, the sector is just not pretty. And is there a reason for that? Maybe. But I think one of the challenges that investors have now is a lot of people just focus on big tech, and a lot of people are focused on Google, but the big problem with big tech right now is this. Big tech are cash machines. Pretty much most of them are cash machines. All of them are cash machines, I should say. The problem is that they're taking those cash machines and they're starting to take that cash and invest it in CapEx or capital expenditures. And they're doing it for AI, data centers, energy, whatever, investing in power plants, whatever they have to do to support their growth. The problem is now all of a sudden investors are not getting that cash. So where's that cash going? Well, it's going into infrastructure.
And investing in CapEx isn't bad. Every company does it to some degree, but just understand that the reason that the bloom is off the rose for big tech is because so much of their cash flow is going into CapEx. We showed some charts last week. We can show them again today if needed, but they're, if you see how much is being put in, it's quite large now and it's growing. So the big question is what is the opportunity set for big tech going forward? Well, it depends. I haven't seen many of them. Google's probably done the best at this, although I wouldn't say it's great, but they've probably done the best of this, of implementing AI into their infrastructure. I frankly don't know what Meta's doing. They've had a lot of misses, with their, with their Oculus, with their metaverse. I mean, they changed the company's name into Meta. They were so convinced on the metaverse that they did that, and yet I think they closed, it was last week or the week before, they closed it. They just said, all right, we're done. We're not doing this anymore.
Was it ever there? I don't even
No,
remember.
it was there. I did look at it. There were some places that were there that you could kind of monkey around with, but it was very, it kind of reminded me back of the early days of the internet and computers where you did things like no one else was there. It was just like a few hobbyists, a few hobbyist gamers were doing stuff, but most people weren't there. Now everybody's, in these places, and it was just empty. There were a handful of people there probably checking it out, but it was mainly empty. There wasn't really much to do. And, while I think the concept is interesting, I mean, I don't know if you remember, Doug, there was a movie called The Lawnmower Man from Stephen King's novel.
Fantastic.
Remember that movie, the first one?
Absolutely.
That was a great movie.
Starring Wolfgang Amadeus Mozart. For those of you get the joke, the actor in it was the gentleman that played Mozart in Amadeus.
Okay.
Same guy.
I don't know who that was, but
yeah, come on.
I don't. It's been a while since I've seen the movie, Doug, so I don't remember all the. But I remember that movie when it came out, and it was basically some sort of virtual reality, which was using like 1980s technology, so everything was very blocky. There was a game called Tanks when I was growing up, not like Tank the Atari game, but like the video, like the video game, the coin-op game, where you had to put your face into this like into this thing you could see, and it looked like you're on a tank battlefield. It was really cool. But anyway, the tanks were like all blocky. So it was like, instead of having like a turret, it was like a triangle. So it was really weird, but it reminded me of that. Like, it was really old school virtual reality, and it was a cool concept. Like the movie and the book, I didn't read the book, but the movie was really cool for like a sci-fi perspective. And I was like, oh, this would be so cool when virtual reality hits, and then crickets, nothing. And now Metaverse came up, and it was like, oh, this is really cool, crickets. I think everybody wants it to happen, but nobody can make it happen. There was a movie with, was it Michael Douglas? It was with, I forget, it was like corporate espionage of some sort. Maybe it was with Demi Moore. Anyway, they had this like sort of virtual reality in that movie too, which looked really cool. Anyway, my point is Meta as a company seems to be struggling a little bit of what it wants to be when it grows up right now. It's doing what it's doing, but they're trying to expand. They tried to get into crypto early with their one of the first crypto tokens. I forget what it was called, but it was one of those. And then they got a bunch of companies together, and they all kind of like disappeared because they couldn't make it work. So I think they've tried a lot of things. I give them credit for their innovation, but their fall through has been lackluster. Google's probably, in my opinion, out of all of them, probably the best to breed, because they're just, they have an innovative culture. They've got some stuff that's maybe not great there, but I think they've been able to thread things together. I don't love their AI, but I think directionally they're doing a better job of implementing than Microsoft has. Microsoft's stuck in this problem where they're in the software sector, and software is getting beat like a redheaded stepchild. The software sector is getting no respect, and rightfully so. Semiconductors are getting a ton of respect, and somewhat rightfully so. Everyone sees the thesis for semiconductors. We need more of them. We need more growth. We need more compute. Whereas software, people are trying to figure out, you got a company like Microsoft, which is, in my opinion, one of the best of breed companies out there for many reasons. But they're in this place where people really don't know what to do with them. Is AI going to eat their lunch? Maybe. I, I think Microsoft's business has so much involved that has nothing to do with AI. I personally think they're safe, but I'm still like scratching my head, like, I don't know. There's still some hair on this thing. I'm not sure where it's going to go, but I think a lot of people are just waiting for things to be determined at this point. So they're unwilling to take big risks. I think companies like, if you look at the Mag 7, Microsoft, Apple, Amazon, Tesla, Google, Meta, Nvidia, if you look at those companies, they're not going anywhere. I crap all over Apple a lot on this show because of how it performs compared to the fundamentals. I don't do it because I don't like the company. I do it just to show a point of the disconnect between fundamentals and technicals and the price. But you've got certain companies like Microsoft, which continue to grow their revenues. You got Google, you growing their revenues. And the big question is AI going to destroy their business model or severely hinder it? And I'll give you an example of what people are talking about. So let's say, I'm just going to make these numbers up, right? Let's say there's a company that's getting 30% growth of revenues each year consistently, year over year. They're the only company, it's a monopoly, like Microsoft has a monopoly on operating systems, right? A virtual monopoly. Let's say, and then you're growing at 30% a year. Let's say they have a PE of 30, so it's kind of matching their growth rate. And by the way, I'm making these numbers up. I'm just proving a point. Okay. And then let's say that AI comes out and let's say a company like Microsoft is only going to grow 10%. Well, now Microsoft is very expensive. It went from mildly expensive to extremely expensive because the price is still the same, but their growth rate drops, which means that the price should probably be lower to account for the lower growth rate. And so what's happening with the software sector is a lot of these companies are getting taken out to the woodshed because investors don't know if they're worth $100 or $20. So they're just knocking it down to 20 because it's easier, and then they don't have to worry about the risk of it. I do think there's going to be a time where people wake up and say, hey, these companies are still worth something, and they're still growing, and they're still well run, and they're not going away. But I'm not the only investor out there. There are a lot of people with a lot of money who disagree and say, oh, these companies are going to zero. I don't think they're going to zero, but I do think their business model is going to get disrupted. Companies that are charging per seat, companies that are overcharging, companies that are, continuing to get away with things because they're the only spot in the space. People are going to start to reconsider. Why do I want to pay way too much for CRM? Why want to buy Salesforce's CRM and pay way too much for something that's, it's quality, but is it worth as much as they're charging? In my opinion, no. For my business, there are companies that probably it does work for, but for mine, it doesn't. So to me, I just say a CRM is easy to rebuild. I think Airtable, if you ever use Airtable, you can use their stuff to create a CRM. It will literally tell the AI, here's what I want. It will create it and it will use the database for the CRM, and you don't have to buy a CRM. It'll just do it for you. So if you have things like that, it's like, okay, that model, okay, maybe there's some issues with that model. It doesn't mean that company is going to be doing poorly. It just means that people haven't figured out what box to put this in. Is this a low growth company or a high growth company? Don't know, right? And that's the challenge that people are facing right now is what box do you fit this in? Now, Apple went through this maybe about 16 years ago. I think it was 2010, 2011. Maybe it was after that. Maybe it was 12 or 13. But anyway, Apple went through this. They were a growth company, and then they switched to a value company. And I remember the year because Apple went down like 30%. Everybody was like, this is none. It's not growing anymore. And it went to become a value company. So all the growth funds sold it and all the value funds bought it. So you had this like swapping of shares into different funds. Ultimately, Apple kept growing. Ultimately, people kept it in the portfolio because it's one of the biggest companies, if not the biggest at certain points. So what ends up happening is people kind of reconfigure their portfolios around this. Now, has Apple grown in the last 3 years, with the exception of recently? No, it was zero growth. But people didn't care. They just kept kept boosting it up. So the things to consider are, what box was Apple in? Well, it was a growth box and went to a value box, and really it was kind of a little bit of both. People eventually figured that out, but for a while, Apple went down like 30%. So Microsoft's gotten taken to the cleaners. I don't remember exactly what it's, how much it's down from the peak, but I will pull that up now. But if you look at Microsoft, the peak was 555, and it went down to a low of 356. Was it a good time to buy it at that? Maybe. Don't know. I mean, we don't know yet, right? We don't know what the market's going to determine. I do think that there's a lot of potential at some of these companies to pick up bargains, but I do think you're taking some risk in that the market could decide that AI is going to eat its lunch. Every week we get new news from AI that something new's come out, that, oh, we just came out with these agents, we just came out with these different models. You've got OpenClaw, you've got all this stuff coming out, and every week it's something new, and people are just trying to wrap their mind around it. And it's just like a shiny object coming out every day. It's great, especially for tech geeks. They love this sort of stuff. The question is how is it going to be implemented? Don't know yet. Is it going to change Microsoft's operating system, Windows? Probably not. Is it going to change their Office suite? Maybe, but probably not right away. You look at if you look at something like Meta, is it going to change their business model? Probably not. And I would guess if these large tech companies were not investing so much into CapEx, my guess is they'd all be fine right now, and the stocks wouldn't be doing anything but going straight up. But they do continue to invest in CapEx, and people are worried about that because it's changing their business model, and people don't know what box to put them in. Is it the growth box, or are we into the old school blue chip? It's just going to trudge along at 10% a year now because you're putting so much into CapEx. I don't know. We're going to find out. But regardless, what you need to know is the things that are doing really well are semiconductors. They are killing it. They're the best performer. Tech is the best sector out there. Is it going to be the best going forward? Not necessarily. Financials are relatively strong, but you've got to worry about the private credit right now, which people seem to have forgotten about. It seems to no longer be an issue. But at the moment, financials are doing okay. Healthcare is starting to make a comeback, but that's a train. It's been a train wreck this year. So I would say just be careful investing. This is why we're telling people just be cautious. Don't be overeager to be quote unquote in the market. Just be cautious. You can put money in the market, but I wouldn't go all in thinking you missed it. We've got another 7 months of the year. And I'd be shocked if the markets go straight up for the next 7 months. I would be absolutely shocked. I don't see that happening. Could it? Yes, but I think it's very unlikely. I think what's more likely to happen is we'll see this, it'll freak everybody out, they'll get in, and then it'll sideswipe people in the next few months. Doug mentioned, this will be the last point, but Doug mentioned the sell in May and go away concept. So typically what happens, and this is a good framework, we talk about frameworks on the show a lot. One of the frameworks is looking at the presidential year, and the second year of a presidential year is typically the worst of the four. Doesn't mean it's bad, just means comparatively it's the worst. And this year is going to be statistically bad until October. In October, until the following April, will be the best segment of the market in all 4 years. So it starts off bad and then it turns into unbelievable. So that's statistically what can happen. Sell in May and go away is typically what people consider. And this starts from like 100 years ago, where people would sell in May and come back in October. And the reason was that people go off for the summer, they go on vacation, right? And because people are on vacation, people don't do anything. So it means there's less volume, which means that people aren't really doing much from May until October. Now, in modern markets, that's less true, but people still talk about it. Do I think this is a great framework? I think it's an interesting framework. It's not something I pay too much attention to, but statistically, in the last bunch of decades, it hasn't really had any meaningful statistical benefits. But it is interesting to think about because in the summer, people aren't there. The last week of December, people aren't there. There are times where the market's just dead and people aren't there. So you don't have these traders, institutions driving market behavior. You just have retail. So I would look at this and say, all right, the statistical analysis is the next bunch of months are not going to be great. The markets do very well, but I would be less likely to believe that things are going to be awesome. So I would look at this and just say, all right, just make bets or investments that are very low risk and very high probability if you're going to make them. There are no sure things right now. The things that look the best could easily be changed in a tweet, right, or a truth social from Trump. All it takes is one, and it changes the dynamics. So just be careful. Doesn't mean you don't have to play in the sandbox. Just be careful if you are, and find things that are strong regardless of what's going on in Iran. So, Doug, what final thoughts from you, and what else you got?
I was looking up a couple things at the same time, but I want to just talk. I think it's really important to understand what's going on right now with personal income and outlays. And so I'm going to share some stuff here that just came in this week in terms of data, because you were talking about government data coming, changing and coming in. So this right here, what we're looking at is the personal consumption expenditures, and really what we're focusing on with this is ultimately one of the most powerful tells in terms of the economy, in terms of measuring average increase in prices for goods and services consumed by households. So as the Federal Reserve is looking at preferred inflation gauge, it's tracking that the changes the consumer behavior too. So you can see here, and what I like about this is we're having an opportunity to kind of look at this from the standpoint of what really occurred over the last year. So this isn't just recently, but what we're seeing here is that from a personal consumption expenditure index percent change from 1 month, from month one a year ago, we were we were under 3%. And again, this is looking at both with food and energy as well as without food and energy. Oh, I'm sorry, we were under 3% at the time, and actually with excluding food and energy was at the time more the personal consumption was higher than it was if it included food and energy. Now, as we've moved into 2026, and especially from February up, and this is not what they want to see in terms of cost going into the midterms. And this is, we're starting to see a little bit from the war. You are actually starting to see that the personal consumption expenditures has actually spiked. And again, why did it? Now it has spiked above what personal consumption expenditures were without food and energy. Why is that? Well, it's very clear, because food and energy have now really come into a greater play with regards to the costs that are being absorbed there. So I think from a standpoint of what's going on with the conflict in the Middle East, definitely starting to see that. And again, now that we're over 3, getting closer to 4, that is going to start to come into play as a hit to ultimately the bottom line of consumers. Now, if we take a look at personal income actually did go up. So that's been offsetting it. Increased 149.2 billion, about a 0.6% at a monthly rate in March, according to the estimates that was released by the U.S. Bureau of Economic Analysis. Disposable personal income, which is personal income less personal current taxes, also increased to 142.5 billion. Personal consumption expenditures increased overall to by 195 billion. So income did grow, but expenditures grew at about $50 to $55 billion more than income, guys. That's something that we can't see. If we go back to the consumer can't easily absorb. If we go back to January, we saw incomes rapidly outgrowing expenditures. So we've definitely hit some significant changes to the bottom line. But again, we're going to start to potentially feel over the next coming months. Now, this chart here, in terms of personal outlays and personal interest payments and personal current transfer payments, that increased 198.6 billion in March. Personal savings was 873 billion in March, and the personal savings rate as a percentage of disposable personal income was 3.6%. The increase in the current dollar personal income in March primarily reflects increases in compensation and farm proprietors' income, partly offset by a decrease in other government social benefits. So again, how does that play into the government shutdown? Maybe a little bit with the decrease in government social benefits, we might have an increase come back there. 195 billion increase in current dollar personal consumption expenditure reflected an increase of 132.6 billion in spending on goods and 62 billion in spending on services. Now, there's the real tell. You can see that what's falling into goods and is gasoline and other energy goods. Significant spike. No surprise to anybody. Outweighing everyone in billions of dollars of seasonally adjusted annual rates. That's going to start hitting, and you can see motor vehicles there as the third. You can also see food and beverage. And guess what? I know it's, the organic files out there, they talk about this all the time, but there is actually a lot of oil and energy in your food as well, depending on what you eat, non-durable goods, transportation services. So look down this chart. All of these things have somewhat of an impact that is going to end up being, potentially starting to eat at the bottom line. Lastly, just kind of looking at this chart, personal income and related measures. I think the key here is take a look at the February to March, right? The February to March that was a significant jump coming to March. Now that we have gone through April, that data is not there yet, but I think that, looking ahead at what those numbers are going to look like, looking at the fact that this doesn't take into consideration the significant jump in gasoline prices that just happened over the last week, it doesn't bode well for us to look at data coming in from April either. The other thing that I wanted to kind of show here too is I think it's certainly a much more telling of what they're facing. But these are the national average gas prices. We are now seeing that the worst recorded prices, the most expensive recorded price for regular unleaded now is over $5 a gallon. Diesel now getting up to $5.8 a gallon. And if we look at the current at 4.3, and we look a week ago, it was only 4. We look a year ago, it was only $3.18 or 19 cents for regular. Now you're starting to see, of course, diesel going from $3.50 up to $5.55. Kirk, you talked about it. Transportation, significant trickle down through the economy on that. And we want to see where that's hitting the worst. No surprise to most people, but if you're on the West Coast or you're on the East Coast, especially the Northeast coast, they're seeing the biggest hits to those retail gas prices. Surprisingly enough, Michigan, Ohio, and Indiana getting hit really hard. Not a surprise to anybody about Illinois. I don't know if people know this, but Illinois, as we come into the summer months, is going to get hit badly because they are known for something called Chicago gas. It is a change of formula that they implement going into the warmer season every year. It causes the price of gas to be about anywhere from 50 cents to $1 more than anywhere else. So this is what they're seeing in gas prices, and they haven't even changed the formula over yet that I'm aware of. So if you live in Illinois area, get prepared to feel a little bit more pain. This is something for fun I wanted to say before I close out, Kirk, in a couple minutes. You mentioned Altria. I don't know if people have noticed lately watching television, but this plays right into Altria. Now, Altria's got some challenges because they actually own a pretty big stake in InBev, Anheuser-Busch. Now, if you've been following it, the next, Generation Z, especially Y, but definitely Z, not drinking. There's been a massive drop off in alcohol consumption. Now, they are getting that from other sources. They tend to like their cannabis related products. Those have spiked. And Altria does have a large stake in Canadian cannabis as well. But where they're also starting to see a spike again is cigarette smoking. And if you haven't noticed watching TV and movies recently over the last couple of years, we're starting to see something we haven't seen in the last 20. It's become popular, kind of a way of kind of reflecting to, the days gone by, that nostalgia, but they're starting to market and push more cigarette smoking propaganda back into TV and movies. I noticed it myself, and then I went to do the research, and it's indeed true. So we are, interesting enough, they're not drinking as much, but we are starting to see that kind of secular rebellious shift in smoking. And if you go back and look at the data of smoking, it seems to have historically always followed these cycles. If the parents smoke, the kids don't want to. That's the rebellion. And that's what we've gotten in the last 20 years. Prior to that, though, you didn't have the smoking, and then that created the rebellious smoking of the 70s, 80s. So it goes through these big time spike cycles. We might be getting into, and it's early, another cycle of seeing that the rebellious, future is going to be smoking again. So anyway, I just thought that was, I'm just going to stop sharing here, but that's going to be something I thought was very kind of an interesting tidbit. So if you notice that around you and watch it, it is, if you thought that maybe that was looking like it's a little more true, you might be right. And so just to close out today, we are definitely starting to see that we have data that is giving us something we didn't have before. Confirmation. Growth is slowing, inflation's still sticky, wages aren't breaking, housing isn't recovering. So these are things that are definitely, out there. It's not a crisis. And by the way, rents, another chart I didn't show, rent prices are dropping in most of the country right now. That is a sign of consumption, affordability, obviously demand. It just can't get the rents they did. They're not going up. But so this is not a sign of strength either. This is where it gets interesting. Markets are holding up. Prices are stable. Confidence is still there. But underneath that, momentum is fading. And when that gap opens between the markets, what they're pricing, and what the economy is doing, that's where the next move comes from. At Merchant Advisors, we don't try to guess what happens. We build plans that hold up regardless. We map everything: income, assets, liabilities, taxes, college funding, huge drain of wealth, something people that listening know that I spend a tremendous time working on because it's an area that most people in my field don't focus on. And ultimately, that impacts retirement income. So therefore, you're not just dependent on the market being right. Because sometimes these markets are early, sometimes they're late, sometimes the data is wrong. And the only way to navigate that is with clarity. And if you understand where you stand and you want that clarity, go visit us to learn more at mergentadvisors.net, MERGENT, mergentadvisors.net. Also, I just revamped my LinkedIn, so look for me on LinkedIn to see, and I'm certainly welcome feedback. It's Douglas Hagren, my last name, HEAGREN. Go check out my new, my LinkedIn update, and let's start the conversation, because the next move isn't going to come from headlines. It will come from reality catching up. Thanks for joining us today, and we'll see you next time.
Yeah, thanks for coming on, Doug. And one other piece of information that I forgot to mention was that Jay Powell will no longer be Fed chair. He is voluntarily going to be stepping aside this time. I'm not sure why that was even a consideration, but he's stepping aside and he will remain on the board. And apparently the Department of Justice dropped their lawsuit against the Federal Reserve. So all stuff that doesn't matter to my day-to-day life, but I thought I'd mention it. So we have, I guess we still need Senate confirmation to change Fed chairs, but that should happen soon in this month of May. So anyway, since we won't talk to you beforehand, may the 4th be with you, and happy Cinco de Mayo. And that's the show for this week.
Thank you again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel. for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.